Seniors Security Update, the new 6,000 tax deduction. Most seniors don't know exists and how to claim every dollar before it's gone. Hey, welcome back. I'm Zane, and I need you to stop whatever you're doing right now. Because if you are 65 or older and you have already filed your taxes this year, or you are about to, there is a very real possibility that the IRS owes you thousands of dollars, and you are about to walk away without claiming a single cent of it. I'm going to say that again so it lands properly. The IRS may owe you money right now. Not someday. Not next year. Right now, this tax season. And the reason most seniors are going to miss it has nothing to do with how smart they are or how carefully they've managed their finances their whole lives. It has everything to do with the fact that a brand new tax rule quietly took effect this season, and almost nobody is talking about it clearly enough for it to actually reach the people it was designed to help. That is exactly what Seniors Security Update is here to fix. By the time we are done today, you are going to know exactly what this new deduction is, exactly who qualifies, exactly how much money we are talking about, and exactly what you need to do to make sure you claim every single dollar you are entitled to. I am also going to show you the specific mistake that is already costing seniors hundreds, sometimes thousands, of dollars this filing season, so you do not make the same error. Stay with me for all of it, because I promise you, the information in this video is worth far more than the time it takes to watch it. The big picture, how your taxes actually work and why this year is different. Let's start at the foundation, because I find that when people understand how the system actually works, everything else makes a lot more sense. And understanding this is going to make the new deduction click for you immediately. Every year when you file your federal income tax return, the IRS is not taxing every single dollar you received that year. What they are taxing is something called your taxable income. Your taxable income is your total income minus all the deductions you are legally allowed to claim. Think of deductions as dollars that get subtracted from your income before the IRS calculates what you owe. The more deductions you have, the lower your taxable income. The lower your taxable income, the less tax you owe. In some cases, enough deductions can bring your taxable income all the way down to zero, which means you owe no federal income tax at all. That is the core mechanic of the entire system. And that is why what Congress just changed is such a significant development for retirees across this country. Most seniors are filing taxes on a combination of Social Security income, pension payments, retirement account withdrawals, maybe some investment income, and possibly a part-time job or some occasional gig work. The income picture for most retirees is relatively straightforward. What has changed in a very meaningful way this tax season is how much of that income you are allowed to subtract through deductions before the IRS touches it. The new $6,000 senior bonus deduction, what it is and where it came from. Here is the centerpiece of everything we are talking about today, and I want to explain it as clearly as I possibly can because this is the deduction that has the potential to put real money back in your pocket right now. As part of the One Big Beautiful Bill Act, which was passed by Congress and signed into law in 2025, there is now a brand new additional tax deduction available specifically and exclusively for people who are 65 years of age or older. It is being called the Senior Bonus Deduction, and it is worth $6,000 per qualifying person. If you are married and both you and your spouse are 65 or older, you can potentially claim $12,000 in this new deduction, $6,000 each. Now here is what makes this deduction genuinely remarkable and different from a lot of tax changes you may have heard about in the past. This is not replacing any existing deduction you were already receiving. It is not a modification of the standard deduction you have always been entitled to. It is a completely new additional amount of money that gets subtracted from your taxable income on top of everything else you were already eligible to claim. And here is the part that really matters for a lot of retirees. It does not matter whether you take the standard deduction or whether you itemize your expenses. Either way, you can still claim the $6,000 senior bonus on top of whichever approach you use. That flexibility is genuinely rare in the tax code, and it is a big deal. Who qualifies? The rules you need to know now. Let's talk about the eligibility rules, because there are specific requirements and you need to make sure you understand them clearly before assuming you qualify. First, the age requirement. You must be 65 years old or older by December 31st of 2025 to qualify for this deduction on your 2025 tax return. If your 65th birthday falls on January 1st of 2026 or later, you do not qualify for this particular tax year. This deduction applies to the 2025 tax return that you are filing right now in early 2026. Second, there is an income limit. This deduction does phase out at higher income levels, so let me walk you through exactly where those limits sit. If you are a single filer, your modified adjusted gross income, which is essentially your total income before most deductions are applied, must be under $75,000 to claim the full $6,000 deduction. If your income is above $75,000 as a single filer, the deduction begins to phase out gradually and get smaller. For married couples filing jointly, the income limit is $150,000 in combined income to receive the full $12,000 combined deduction. Here is what I want you to hear clearly. For the vast majority of retired Americans who are living primarily on Social Security, pension income, and modest retirement account withdrawals, you very likely qualify for this deduction in full. The income thresholds are set at a level that covers most retirees on fixed incomes. This was intentional. The deduction was specifically designed with retirees in mind. If you are not certain where your modified adjusted gross income lands, your tax software will calculate it for you, or a tax preparer can tell you in about 5 minutes. Do not guess. Find out. Because if you are close to the threshold, there may be legal strategies available to bring your income just below it and capture the full deduction. What this actually means in real dollars. A real example. Let me make this concrete, because percentages and deduction amounts are abstract until you see them applied to a real situation. Imagine a woman named Barbara. She is 68 years old, she is single, and she receives $20,000 a year in Social Security benefits. Because of the way Social Security taxation works, roughly 85% of that, about $17,000, is considered taxable income. She also receives $13,000 a year from a small pension. So her total taxable income before deductions is approximately $30,000. Under the rules that existed before this new law, Barbara would take the standard deduction for her age, which already includes an extra amount for seniors. That brings her taxable income down to a certain level, and she pays federal income tax on whatever remains. But now, with the new $6,000 senior bonus deduction added on top of everything else she was already entitled to, her taxable income drops significantly further. The result is that her federal tax bill goes down by hundreds of dollars, potentially $700 or more, compared to what she would have owed under the old rules. For someone like Barbara, living on a fixed income, that is not an abstract number. That is grocery money for 2 months. That is several months of prescription costs. That is real, tangible financial relief that she has done nothing different to earn. She just has to know the rule exists and claim it correctly. The standard deduction numbers for 2025, and why the math has changed for most retirees. Now, let's layer in the full picture of what is available to seniors this filing season, because the $6,000 senior bonus does not exist in isolation. It sits on top of an already generous standard deduction that has increased significantly. For the 2025 tax year, the standard deduction for a single person who is 65 or older combines the base standard deduction plus the additional age-based amount that seniors have always been entitled to. When you add those two components together and then stack the new $6,000 senior bonus deduction on top, the total deduction available to a single senior is historically high. For a married couple where both spouses are 65 or older, the combined total of all deductions stacked together, the base standard deduction, the age-based additions for both spouses, and the $6,000 senior bonus for each, can approach or exceed $46,000. What that means practically is significant. If your combined household income is below that threshold, you may owe no federal income tax whatsoever this year, And even if your income is above that level, you are going to owe substantially less than you did in prior years. This is also why the decision of whether to itemize or take the standard deduction has shifted dramatically for most retirees this season. For decades, many seniors itemize their deductions, listing out mortgage interest, charitable donations, medical expenses, property taxes, and so on, because the total added up to more than the standard deduction. But with these new higher deduction amounts, that calculation has changed for the majority of retirees. If you have already paid off your home, you do not have mortgage interest to deduct. Without that, it becomes very difficult for most retirees to accumulate enough itemized deductions to beat the new, much higher standard deduction. So this year, many people who have been itemizing for 20 or 30 years are going to find that simply taking the standard deduction, including all the senior bonus amounts, gives them a better outcome. The only situation where you might still benefit from itemizing is if you had very large medical expenses last year. The IRS allows you to deduct medical costs that exceed 7.5% of your adjusted gross income. So if your adjusted gross income is $50,000, you can only deduct medical expenses above $3,750. If you had a major surgery, a significant hospital stay, substantial dental work, hearing aids, or other large health expenses, you might clear that threshold by enough to make itemizing worthwhile. But for most seniors with typical medical costs, the new higher standard deduction still wins. Run the numbers or let your tax software run them for you. Do not assume. The mistake that is costing seniors money this season. I told you at the beginning of this video that I was going to show you the specific mistake that is already costing seniors hundreds and sometimes thousands of dollars this filing season. Here it is. The $6,000 senior bonus deduction does not apply itself automatically just because you are 65 and you file a tax return. It has to be specifically claimed on the correct form in the correct place. And there are seniors right now who are filing their returns, using the same software they've used for years, following the same steps they always follow, and missing this deduction entirely because their software is not fully updated or because they are not answering the eligibility questions carefully enough. If you are filing by hand on paper, you must be using Form 1040 SR, which is the U.S. tax return for seniors. This form has larger print, it is easier to read, and it includes a specific built-in chart for calculating the senior standard deduction. It also has a checkbox specifically for people who are 65 or older, and checking that box is what triggers the age-based deductions you are entitled to. If you are using the regular 1040 form instead of the 1040 SR, you may be missing deductions you qualify for. If you file electronically using tax software, the software should automatically detect your age and apply the appropriate deductions, but always verify. Look through your return before you submit it. Find the line where the senior bonus deduction is applied. If you do not see it and you qualify, something went wrong and you need to correct it before you file. This is one of the most important reasons I strongly encourage any senior who has any uncertainty about their filing to use a reputable, fully updated tax software program, or to visit a free tax preparation site this year. The rules are new enough that you want professional eyes on your return to make sure nothing gets missed. Free tax. Help that most seniors don't know is available. Speaking of free help, let me take a moment to make sure you know about the resources that exist specifically for you, because this is information that does not get nearly enough attention. The AARP Foundation runs a program called Tax Aid, and it is completely free. They have thousands of locations across the country, in libraries, community centers, shopping malls, banks, and senior centers. Trained volunteers who specialize specifically in senior tax issues will sit down with you, go through your documents, and prepare your complete return at no charge whatsoever. These volunteers are specifically trained on the rules that affect seniors, which means they will know about the new $6,000 deduction, the updated standard deduction amounts, and everything else we have discussed today. You can find a location near you by visiting aarp.org/tax or by calling 1-888-227-7669. There is also the IRS Free File Program. If your income was under $89,000 in 2025, You can use guided, professional-grade tax software completely free through the IRS website to prepare and electronically file your federal tax return. You pay nothing. You go to irs.gov, click on Free File, and the software walks you through the entire process. If your income was above that level, you can still use Free File fillable forms, a more basic option, but still free for everyone regardless of income. Please do not pay for tax preparation if you do not have to. The money you save on preparation fees is money that stays in your pocket. Social Security and taxes. The part that confuses almost everyone. Let me address something that generates more confusion than almost any other tax topic for retirees, and that is whether your Social Security benefits are taxable. The answer is, it depends on your total income. And here is exactly how it works. The IRS looks at what they call your combined income, which is your adjusted gross income, plus any non-taxable interest you earned, plus half of your Social Security benefits added together. If you file as a single person and your combined income falls between $25,000 and $34,000, then up to 50% of your Social Security benefits may be subject to federal income tax. If your combined income is above $34,000, up to 85% of your Social Security benefits can be taxed. For married couples filing jointly, the thresholds are $32,000 to $44,000 for the 50% level and above $44,000 for the 85% level. Now here is the genuinely good news. The new $6,000 senior bonus deduction can help offset the taxes on your Social Security income. For many lower-income seniors, this new deduction may effectively eliminate federal income tax on their Social Security benefits entirely. That is a meaningful, real-world benefit that can make a significant difference in your monthly financial picture. One more important point on this. Just because your Social Security benefits may be taxable at the federal level does not mean they are taxable in your state. Many states do not tax Social Security benefits at all. Your state tax calculation and your federal tax calculation are entirely separate, and you need to check your specific state's rules. Required minimum distributions. What every retiree with a retirement account must know. If you have a traditional IRA, a 401k, or a similar tax-deferred retirement account, there is something you must understand and must not get wrong. Once you turn 73, the IRS requires you to take a minimum amount of money out of those accounts every year, whether you need the income or not. This is called your Required Minimum Distribution, or RMD. That withdrawal is fully taxable as ordinary income, and if you fail to take your RMD by the deadline, which for most people is December 31st, the IRS can assess a penalty of 25% of the amount you were supposed to withdraw but did not. That is an enormous penalty that you absolutely want to avoid. Here is how this connects to the new deductions. When your RMD gets added to your taxable income, the new $6,000 senior bonus deduction, stacked on top of the already generous standard deduction, can help offset the taxes on that withdrawal. Working with a tax professional to coordinate your RMD amount with your available deductions is a strategy that can meaningfully reduce what you owe. Some retirees are also exploring a strategy called a Roth conversion this year, which involves moving money from a traditional IRA, where contributions were made pre-tax, into a Roth IRA, where future growth and withdrawals will be tax-free. When you do a Roth conversion, you owe income tax on the converted amount in the year you do it. But with the new higher deductions available to seniors in 2026, some retirees have what is called unused deduction space, meaning their deductions add up to more than their current taxable income, leaving room to absorb some converted funds with little or no tax owed. This can be a powerful long-term planning move, but it is one you should discuss with a qualified tax professional before executing, because it is not the right strategy for everyone. Gig work, online sales, and the forms you cannot ignore. I want to cover something that is catching a growing number of retirees off guard this season, and that is the tax treatment of gig work and online sales. If you have been driving for a rideshare service, doing freelance consulting, selling handmade goods, or performing any other self-employment work on the side, and you earned $600 or more from any single client or company, you will receive a form called a 1099 NEC. This income is treated very differently from regular wages. It is subject to self-employment tax, which is currently 15.3%. Unlike wages from a traditional employer, nothing is automatically withheld from this income. The responsibility to report it and pay taxes on it falls entirely on you. This surprises a lot of retirees who are accustomed to having taxes handled automatically. Report this income on Schedule C. Do not skip it or fold it into the wrong line on your return. Similarly, if you sold items on eBay, Facebook Marketplace, Etsy, or any similar online platform and received $600 or more in total payments, that platform is required to send you a Form 1099-K and report that income to the IRS as well. If you sold personal items for less than you originally paid for them, you generally do not owe tax on the transaction, but you still need to report it correctly. If the 1099-K shows up in IRS records and your tax return does not account for it, you will receive a notice. Do not ignore these forms. The filing deadline and what you need to do right now. The federal tax filing deadline for most Americans is April 15, 2026. You have until that date to file your federal income tax return. If you need additional time, you can request an extension, which gives you until October 15th. But here's the critical point that many people misunderstand. An extension to file is not an extension to pay. If you believe you are going to owe money, you still need to estimate that amount and pay it by April 15th, or interest and possible penalties will apply to whatever is paid late. If you are expecting a refund, the fastest way to receive it is to file electronically and select direct deposit. The IRS typically processes electronic returns and issues refunds within 21 days. Paper returns take significantly longer, sometimes 6 to 8 weeks or more. With all the new rules and changes this season, there may be additional processing time involved. Do not wait until the last minute. File as soon as you have your documents in order. And one more thing, if you have a My Social Security account set up at ssa.gov, you can log in and download a replacement copy of your SSA 1099, the form that shows how much Social Security you received last year, without waiting for it in the mail or spending an hour on hold with the SSA. If you do not have a My Social Security account, set one up. It also allows you to review your complete earnings history, verify your benefit amounts, and manage other important account information all in one place. The bottom line from Zane. Here is what I need you to walk away from today's Seniors Security Update knowing, and I want to say it as plainly as I possibly can. This tax season is genuinely different from previous years, specifically for seniors and retirees. The new $6,000 senior bonus deduction is the biggest change, and it has real potential to save you meaningful money. But it does not happen automatically. You have to file a return. You have to claim the deduction. You have to make sure it is being applied correctly on the right form in the right place. You also need to make sure you are using the correct forms, reporting all your income accurately, including gig work and online sales, understanding how your Social Security benefits interact with your overall tax picture, and taking full advantage of the free resources available to you if you need help filing. Whether you use a reputable tax software program, visit an AARP tax aid site, or work with a local CPA or enrolled agent, please do not simply file the same way you always have and assume nothing has changed. This year is different. The rules are different, and if you file on autopilot without accounting for what changed, you may leave a significant amount of money on the table that is rightfully and legally yours. Please share this with everyone in your life who is 65 or older. Parents, grandparents, neighbors, friends, anyone who is retired or getting close to retirement age. Most of them have no idea this new $6,000 deduction exists. The news is not covering it clearly enough. You can be the person who makes sure someone you care about does not miss money they are entitled to. I'm Zane. This has been Senior Security Update. Take good care of yourselves, file smart this season, and I will see you in the next one. Stay informed. Stay protected.